This video is brought to you by the Concrete Pumping Association of Australia. For more information, please visit our website or give us a call today.
Good morning and welcome to the Concrete Pumping Association of Australia's Financial Benchmarking webinar for 2019. Before we get in and hand it over to our speakers today, I just want to give you a bit of an outline of how today's webinar is going to be conducted. We expect the first part of the presentation to take about 45 minutes, and at the end of that we will have a Q&A session. Attendees can submit questions through a panel and there will be a series of selected polls during the webinar. This webinar will be recorded and posted online post the event. Copies of the actual financial benchmarking report will be made available to members again following today's webinar. If you're not a member and listening in today, you will be able to get a copy of the report, but you need to become a member of the association. So, the financial benchmarking study. Why are we doing this? Well, the motivation for the study was predominantly built around the fact that there was a lack of financial data specific to our industry. And we looked to the US in terms of the American Concrete Pumping Association, and the fact that they have been doing this for a number of years has given them a level of insight into their industry to understand how they can improve their business, moreover benchmark themselves against industry averages and look at ways in which they can improve the performance of their businesses. To that end, who has been involved is a company called Profit Soup, and Barbara and Stuart are people that have been involved in the development of previous reports from the American Concrete Pumping Association, and we've engaged them to produce today's report, but more importantly to summarise the results of the Australian benchmarking study. You'll find some results are interesting in that there's strong alignment with the American reports previously produced, but there also are some differences that they will highlight. So how can you get involved? Obviously being involved in today's webinar, but secondly, Barbara and Stuart are keen to meet with some of our members that may not have been involved in the inaugural benchmarking study and might like to have their business benchmarked to those new results that we've potentially produced through the association. And I'm sure Barbara and Stuart would welcome a call from you. So just quickly a snapshot about our industry. It's always important to remind ourselves of the scale and scope of our industry. We know that there are approximately 1,300 concrete pumping related businesses operating throughout Australia, and about 20% of them are members of our association. Obviously we'd like to have more capture, but you know, that's the nature of industry. That industry operates approximately 8,000 pieces of equipment and employing about 13,000 people. We are a part of a large construction materials industry of around about $11.7 billion turnover annually, which is a pretty significant industry in the scheme of things. The association is really the national body representing the interest of that industry, and therefore we seek to provide a strong and unified respected voice for the concrete pumping industry to improve our professionalism, to represent ourselves on standards and improve our safety and performance of the industry. We obviously are engaged in a lot of different forums, and we provide, I believe, valuable advice, and also the association produces a series of safety products and services. But we can only do this with your support. We represent the industry through the membership and the support of that membership. And we obviously are there to ensure the sustainability of our industry and the safety of our employees. I'll now hand over to Barbara and Stuart, who will take you through the presentation.
Anyway, just moving on. So it is a case of looking at the figures from this benchmarking study to be able to compare yourself to others. And it is with this perspective that you can clearly understand what you're doing well or what you're doing not so well, and set yourself a plan to work on that to improve the results, to take the action, and as it says on the slide, to get it done. It doesn't stop there. You measure again, you monitor your progress. It is a process, it's not a project, and you keep doing it again and again. The study that we're talking about today measures the financial results for the 2018 financial year. That might seem like old news, given that we're all tapping on the 30th of June year 2019 right now, but it's a very, very strong starting point, and that's a good thing because now we've got a point of reference to see how we're trending financially. What I'd like to do is take a moment to share with you a picture of what we measured for the study, and the picture basically summarizes how Barb and I see business finance, and it all starts with revenue. The one thing we're all comfortable with is sales. How fast are you growing? How fast are others growing? From the study, you'll see that the middle guy grew revenue by between 10% in 2017 and 18, and the top performers grew their revenue at almost a level of 22%. So if we accept that it all starts with sales, what we also know is that sales drives productivity. And when I say productivity, what tends to come to mind, and for most people it's words like, well, efficiency, people, capacity, maybe even utilization. We'll talk more about that. To me, productivity is simply about using the resources of your business as efficiently as possible. In this business, your most important resource is generally your team and your equipment. Concrete pumping is, equipment heavy, let's say. In this study, we measure how efficiently you drive your sales from your team by measuring the sales per employee. We look at the efficient use of your equipment, referred to as utilization, and these things can be measured, and when you do, you can see if you're managing it well or if you're not, and by comparing to the benchmarks of others. With good productivity, your business will create profit. If you can just pull that up for me, Barb, and cash. But you notice that they're two different things. The arrows go in two different ways, and that's deliberate. That's because profit and cash are not the same thing. And you can ask yourself the question, is it possible to have profit and no cash? And there's way too many, unfortunately, there's way too many people who have learnt the hard way that the answer to that can be yes. You can make a sale, you can make a profit on it, but unless you collect it, you don't have the cash. Debtor collections is a huge driver of cash flow, and if you collect too slowly, you'll feel it in your checkbook. However, if you manage your profit and your cash well, what you'll find, thanks Barb, bring up financial strength, what you'll find, if you manage your profit and your cash well, you will build financial strength. Because with strong profits and good cash management, you can grow your business while keeping your debt under control, which is really important. It builds equity and it builds the value of your enterprise. The picture you see in front of you is what the benchmark study measures. By comparing your results in the study, you can see where you're going well and not so well in the four areas of productivity, profit, cash, and financial strength. We use the P&L to measure the profit side of the picture, and we use the balance sheet to measure the cash side. And you guys all filled out a survey form to get everyone on the same page on how you categorize your expenses. So even though you might have some nuances or some differences in how your financial statements might be laid out, comparing one to another, for the purposes of the study that we've just completed, everyone used the same survey, which gives us a standardization of the data. So this is what we measure and where we get the information from, but what I'd like to do is just hand over to Barb and get her to tell you a bit more about what's in the study. Over to you, Barb.
Great, thanks, Stu. So I appreciate that overview of what we measured. Before we dive into talk about the specific numbers about what we did find, I want to share a little about the project itself and about what the deliverables are, it contains two major pieces. There's a document that we call the benchmark study, and that's what Craig had spoke of a little earlier. And it has the aggregate figures from the companies that participated in the project. So all members are entitled to receive a copy of that study. Now, you will not find anyone's individual results there because the study's confidential. And I'm an accountant. I'm a certified public accountant in the US. Confidentiality is very important to me, and I know it's very important to all business owners. So we don't show the individual numbers of any one company. Instead, we show the aggregate figures for all of the companies that participated, but then we segment the results for just the ones that we identified as the top performers or the top half. And I'll tell you a little bit more about how we decided who made the cut in a moment. We also segmented the results into categories based on turnover if you were over 2 million or under. So we put people into two different buckets, and we've got the aggregate figures for the people in those various buckets. So if you're a company that's doing $1.5 million in turnover, you would want to compare yourself to those for the companies under 2 million. So if you participated in the study, though, you got that second item, and that what you see on the screen here is it says your interactive business improvement workbook. And this is a customized interactive workbook that shows how your numbers compare to the benchmarks in the study. And it also provides a format for how you can use the workbook and the information to do your own little business improvement plan. It's a step-by-step approach. There's 5 steps, and we're going to be talking about what those are at the end. So when we do our wrap, we'll say, okay, now that you have this information, here's what you can do about it, and we'll go through those 5 steps. So, but let's jump in and look at the fun stuff. So we identified the companies that had the highest EBITDA as our top performers. And what I mean by that is the earnings before interest, tax, depreciation, and amortization. So in other words, we took the bottom line and we added these things back. So we did that so that if someone had taken advantage of like a bonus depreciation or one-time write-offs for tax purposes, it wouldn't taint the numbers. So also by eliminating interest expense from the mix, we put companies who borrow a lot on the same playing field as companies who might be acting as their own bank. So we take the interest out of the mix when we say how efficient is a business performing, because I want to know how efficiently you're operating, like doing the work, not without respect to how you're actually financing the business. So what we did was we calculated people's EBITDA. We compared that to the revenue to get it as a % of total revenue. So the top half are the people that had the highest EBITDA as a % of total revenue. Now, this is not necessarily the companies that had the highest turnover, and it is not necessarily the companies that had the highest profit dollars. Now, having said that, bigger is better in this business. We were looking for efficiency. We're looking for the people that are the very best, taking a buck on the top line and squeezing something out of it on the bottom line. And what we find is what we would expect is that bigger is better in this business. And to kind of show you how it laid out, if I took the median sales for everybody in the group that participated, it was $3.5 million. But for the top half, those who were the most profitable, it was $5.7 million. So size does matter. And this is partly because we have a significant amount of fixed costs in our business, right? Our equipment costs, we got to pay for it, whether we're working it or not. And that is the driver of success in this business, is that utilization of that equipment. And if you have the fixed amount of cost, if you drive a lot of sales from it, it makes it a smaller expense percentage, which is what gives you the bigger profit percentage at the bottom line. So Craig, this is a great time for our first polling slide. our median EBITDA was 7%, I'll tell you that. So now let's talk about this word median. Craig, can you put up polling slide number 1?
Yep. So I just posted the polls. Barbara, I just need to briefly explain. We had a bit of a technical glitch during the initial start. For some reason, it didn't actually start broadcasting when I was doing the introduction, so people would have been unaware of what was going on. But we are putting up a number of polling questions in the panel. You'll see them on the right-hand side. And Barbara's going to explain the question, and please look at the responses that you can select, and we'll get a real-time response from you about this particular question. Over to you, Barbara.
Right, so I'm not actually seeing the poll, but the choices that you have are, so the question is, what best describes a median? The choices are the total values of a list, the sum of the values divided by the number of entries in the list. Is it the halfway point in an ordered list of values, or is it the value that appears most frequently on the list? So the poll is open, and you can enter your response to that and tell me what you came up with for the poll. We'll just give you a few more minutes. Click whichever box you think best describes the median.
Over 50% have voted now, Barbara. We're closing it out.
Right. So, yes.
Sorry, Bob, go on. I was just going to say, while people are finishing off and having a look at that poll, I did notice that the study has some pages that have median figures and some that have averages. The pages are clearly marked at the top as to whether they use either the median or the average, but in some cases the numbers were quite different. And I'm thinking that it's important we take a moment here to describe why that is.
So Craig, before we move on, would you let us know how the polling came out?
That's the results on the screen now, Barbara.
I can't see them, so.
I can.
Can you see them, Stuart?
So yes, I can. The vast majority said the sum of the values divided by number of values, and there were a smaller number that said the halfway point, and roughly the same number said the value that appears most frequently. And I'll see if I can see the percentages. 78% said it was the sum of the values divided by the number of values, and 11%.
Which is actually the average.
Yeah.
That's the average. So the correct answer was the halfway point in the ordered list. And that's why it's so important that we're going to stop and spend a moment talking about the difference between a median and an average now.
Okay, I'll hide those results, Barbara. So back to you.
Thanks.
Yeah, I mean, I was going to. So if we take a look at the slide in front of us now, we've got 5 results. To get the median from that, we list numbers from high to low and find the one in the middle. Half of the members in the list achieved a result higher than 120,000 and the other half lower. Now let's look at the average. If we added all of those figures together, we get the total of 500,000. We'd simply divide by 5 to get the average, which is 100,000. So as you can see, the average is significantly lower than the median. So it does sort of beg the question, which is the best benchmark?
You're right, Stuart, and that can be a little bit confusing. Usually, the median is a better benchmark because the average can be tainted by one unusually large or unusually small result. So the outliers can make the average move one way or the other. When you look at the median, you always know that half of the responses were something higher and half were lower. So you always know your ranking when you use the median. But we do have a little bit of each in the study. And on the pages are well marked. There are median benchmarks that measure productivity, profit, cash flow, and financial strength. And those things sound familiar to you because Stuart showed you that picture, that those are the things that drive value. But we also have some average statements, and we have the average profit and loss and the average balance sheet. So all of those are there for you. I prefer to work with the median wherever I can. Let's talk about what the medians were here, were for some of our important metrics. We mentioned that the way we decided who is in the top half, the top performers, it was the people who had more than 4.6% in EBITDA. So half of the companies had a number higher than 4.6%, half of the companies had a number lower. So when we look at the top half, you know that it's everybody that's in that group made more than roughly 5% of the bottom line. And the median for the top 25% was actually 21.5%. So there's a lot of upside potential in that group. So half of the top half got a number higher than 21. So in the study, wherever you see the numbers for the top half, you know it's the people that earned more than 4.6% EBITDA. Now, of course, what we really want to know is what did those most profitable companies do differently to earn those big profits?
Yes, that's right, Barb. And the one thing that jumps out at me was gross profit, and you can see it on the screen there, and that being your revenue minus your direct costs. The top half had a gross profit of 27%, and the average of all companies was 21.2%. So that's a pretty big difference of roughly, or actually 5.8%. And if you apply that 5.8% to the median sales of 5.7 million, it represents over $330,000 in lost profit, in what's been left on the table. Barb, can you tell us what things are included in the direct costs, and also how does this compare to the gross profit for the US companies that you've studied?
Sure, Stu. Here's a list of the items that are included in direct costs. The biggest one is direct labor, and your equipment costs are also here. So you got fuel, repairs, maintenance, tire replacements, the operating supplies, the equipment leases and depreciation are also here. These are the things that get used or consumed on the job, okay? You absolutely got to have them. They relate directly to the job. Now, we last studied this in the US a couple years ago, and the median gross profit using these same expenses was actually in the low 30s, with the top performers earning like 40% or more. So that's significantly different than what we're seeing here in the Australian companies that we studied. And that is that gross profit margins are a bit higher in the US. Now, what we're going to find out a little bit later on is that they also, though, spend more money on administrative employees. So that's about the biggest difference, though, between the US and the Australian concrete pumpers. Labor costs for the US can run as low as 30%. And that is not the case of what we saw in Australia. And we're going to look at what our actual labor costs were here in a moment. But the other thing is that the US building economy was extremely strong at that time, and demand was extremely high at that time. And we know that two things impact our gross profit percent: our sales price and our direct costs. So when competition is tight, what do? Well, we've got a lot of money invested in these trucks, and the last thing we want to see is a truck in the yard when it could be out pumping for dollars. So when competition is tight, we cut our price to get the business. Now, I'm not working in your market right now, but from the numbers, especially by my looking at the gross profit margin, it looks like this could be one of the dynamics that's in play here.
Yeah, it is, Barb. That is the case. Interestingly, I noticed that while the top performers had 5.8% lower direct costs, as we just went through in the exercise, the labour costs as a percent of sales were nearly identical at 53%.
Yeah, I noticed that too. It was really the equipment productivity that drove the difference. Now, I'd love to take a closer look at what's driving the difference in equipment productivity. I mean, why are we getting more sales from our equipment than for the top 25 than everybody else? Is it because of price, because we're charging more, or is it because of time, because we're working more? Now, I love to peel the onion back and find the details. I just love these numbers things. So a little twisted in that way, but unfortunately I had a little trouble getting the data that I would need to really peel back that onion and to see what was causing the differences.
Can you just, what do you mean by that, Barb? Can you just take that a bit further for us?
Yeah, absolutely. Great segue to the next topic, which is productivity. Okay, how efficiently do we drive sales from the equipment? Now, Stuart, you mentioned that the two biggest resources that we have that we got to be like as efficient as possible with is our equipment and our people, our team. So I want to talk about the equipment first, because that drives right into what we're talking about what data we could get together. Equipment productivity is the factor that separates the top performers. So when we look at how we can actually measure equipment productivity, there are two basic approaches to doing it. You can do it with dollars or you can do it with time. So dollar utilization is pretty easy to calculate because we can get it off the financial statements. So we can measure how much we're generating revenue for each dollar that's invested in equipment, or how much gross profit we're earning for each dollar invested in equipment. And we actually had that information right on the financial statements. And what we saw was that for every dollar invested in equipment, the top performers and the all companies were each getting about $2.42 in sales and about 65 cents in gross profit. They weren't very, very different between all in the top 25. What drove where they were different was based on your sales volume. Okay, so those who had high volume have more revenue per dollar invested in equipment than those that have low volume, as we'd expect. And the same is true for the gross profit, because it's just a function of some percentage of those sales. So the companies with more than 2 million in sales are clearly the most efficient at producing sales and profit from their equipment. So that makes perfect sense to me. What I don't know is how much is price versus how much is utilization, or how much time we actually have it on rent. We've actually asked some questions about how many billable hours did you have? So the second way that we can measure equipment utilization is with time. So like of a day, what portion of a day, or of all the days you had available that you could have rented equipment, what percentage of your equipment hours were really paid hours? That's an important metric for you to know, because that's what tells you if you need to buy more equipment or not. Are you at maximum capacity or not? I couldn't quite get there with the information I had because I didn't have the information about how many hours we were billing. What I did have is I had revenue, and I had the number of equipment pieces, and I could take each equipment piece. If I have 2 pieces of equipment, I have roughly 2 days worth of equipment utilization. So we took pumping revenue per unit per day, and all in the top 25% were around the neighborhood of $1,200 is what we're driving in revenue per unit per day. The smaller companies were driving $700 per unit per day. So it's not because they have fewer units, it's per unit per day. So they're getting less utilization in dollar terms from that equipment itself, and the larger ones are getting more. I am quite certain that if we could get the information about how many hours do we bill, and we could calculate all these additional metrics that I've just put up on the screen, it would be more actionable for people. You'd really know what you need to work on. So for example, we'd know what the revenue per hour billed was. So I would know how pricing was different, and I could say to you, hey, look, one of the reasons why your utilization is down is you aren't charging enough. But I don't know that because I don't have the hours. Hours billed per unit per day, and the percentage of available equipment time that you actually did bill. These are great things, and we can take those same hours and look at the labor and identify what our labor cost per hour and what percentage of our operator hours, that for those who work, what percentage of them got billed. Because we see a lot of money gets left on the table there if we're not billing for travel time, or if we have excessive travel to get to jobs. So these are things, all things that are like, this is what you got to get right and to really make it work in this business. But we couldn't quite get there with the study. Had we been able to do it, there would have been a lot more information that was really, really valuable. So go ahead, Stu.
I was just going to say, absolutely, it would have been, Barb, no question about that. Honestly, I don't know how you can manage without this information when the market is as competitive as it is, when there's not really a lot of room for error, and you need to take advantage of every chance you have to learn how to make your operation more productive. Craig, I think, why don't we do our second poll and ask everyone on the webinar about this?
Want to stay up to date on all things concrete pumping? The Concrete Pumping Association of Australia are here to help. We provide our members with locally relevant, current and industry-leading educational information, whether you're the owner, manager or employee, keeping members pumped up on the latest industry news, e-newsletters, standards updates, events, technical publications, safety alerts, financial benchmarking studies and the annual Concrete Pumping Mag. You'll be the first to find out. Joining is easy. Why not become a member via our online store, cpaasoc.com.au, or call us today on 1300 136 636.
If you can just pull the poll up, and the poll, as you can see, is, do you track or record your hours billed by pump? You can just take a moment to click one of the three options, either no, we don't have a process, or we do have a process but the information isn't accurate, or yes, we track it and it's reliable. And let me know when you got those answers through, Greg.
Yeah, we're at 60, 70% already. Very quick responses.
Yeah.
This is this is actually a really important area for people to know, that if we want to be better, and of course I love data, but if we want to be better, we got to know exactly how to be better. And when you measure it and you can see these things, it's really helpful. But if you don't have the systems, you can't do it.
Exactly.
So do they have the systems or don't they? How did our results come out?
Really well. I mean, pleasingly, 4% of people do track it and with reliability, and then the other two are split 30% each. No, we don't have a process, or we have a process but it isn't accurate. So basically, my read on that is that 70% of the people on this webinar do have a process. Some have got it worked out and some have got to refine it, but that's exciting because you've got a process in place already, and I think as we said earlier, this is just such rich data for you to be able to manage your business more effectively. Great stuff, Barb. We've talked a lot about the drivers of profit margin. What interesting insights though do you have into the rest of the cost, Barb? Because just getting away from just the gross profit, there's a whole lot of other costs in these businesses, as we all know.
Yeah, there absolutely is. Here's the big picture. Okay, I love to distill it down into small buckets because that tells us what's really going on. So the most significant lever we can pull is balancing the capacity of our equipment with our revenue. I mean, those are in the business know that that is absolutely what we have to get right. And that's why so many people do have systems to monitor that. It drives strong margins. Direct labor is a variable cost, so we can control that, and we can see that people do have good control over that. That they're all at about the same level, because you're only going to pay it when somebody's working for the most part, which is not the case with your equipment. You have to pay for that whether it's working or not. So my take on this is that how we drive, that's how we drive our gross profit margins, is through that utilization. So now let's look at the rest of it. I mean, that is the big takeaway. That is the big piece you have to get right. What happens after that is you can only mess it up, all right? So you can only mess it up by not managing these other things well. So let's see what these other things are. I put them into three major buckets here. In the sales general administrative, that's all the other overheads. I put it into three buckets: payroll, occupancy, and other, everything else. So payroll costs, that includes your sales, dispatch, your management, and your back office people, okay? The top half spent 2% of sales less on these people than the average for all of the companies that participated. So there was a 2% benefit there for the top 25. They managed that better. Occupancy, this is kind of, I mean, look at the numbers here. Occupancy, that includes things like your rent, your utilities, the building and the yard, right? And any repairs and maintenance that you made on the building, or yard improvements or yard maintenance. So the top half spent 6.5% less on facilities at 2.3% of revenue instead of 8.9. That's a big difference. When I think about it, well, how does that happen? Okay, we're back to the same thing about how the equipment thing happens. Facilities is a fixed cost. You need to rent an office, you got to have a yard. And once you sign up, the only thing you can do to reduce the cost as a percent of sales is to drive more sales. And so as we get that utilization up, as we get that volume up, the occupancy drops significantly as a percent of sales. So when you're small, you're just like too small to cover it all, too small to get that number down. So the answer is grow sales. So for everything else, I said there's payroll, occupancy, and everything else. For everything else, there really wasn't that much difference. And the top half spent a little bit more, actually, at 5.4% of revenue instead of 5%. But it really wasn't, the big items here are drive volume to get your fixed costs down as a percent of sales, manage people well, have the right amount of equipment. So let's talk about the people costs now. What impacts that cost as a percent of revenue? Why would you be at 4.2% instead of 2%? There's two things. It's the number of people you have and the amount that you pay them, right? And that in relation to our revenue. So in addition to showing our costs as a percent of revenue like it is here, in the study, we're going to measure the productivity of the people, because remember what Stuart said, we got two important resources, the team and the equipment. We measure the productivity of the team and of the people based on our sales per employee ratio. So here, let me show you how this works, because this is one of the things that we can do with this information, and the information that comes from the study, is we can identify how many people we should have. Do I have too many people? Am I paying them too much? So in the study, there are some numbers there on staff cost per person, all right? On average, what did we pay for our sales and our salespeople / admin people? So it's all in one bucket, but we can look at the average of what we paid per person. But we're also looking, when we measure productivity, what did we generate in sales for each person? And that's how we drive our costs down as a percentage of sales, is to drive more sales from the bodies. So now I'm going to tell you that we can figure out if you got too many people by looking at this information. So how would you do that? Well, let's just say, as you can tell by looking at the screen, the top half and all companies were they were about 1.6 million in sales per employee. But if you were over 2 million in sales, they averaged $2 million per employee. So as you get bigger, your employees can produce more, you get more leverage on that. That's what drives the percentages down. So now how could we use this to work out how many people we should have? Well, let's say you have 4 million in turnover. You could take your sales divided by, I don't know, 1.5 million to 2 million. And that's how many sales and admin people you need. So somewhere around 2 to 2.5 full-time equivalent employees. So I want you guys that are on the webinar here, you men and women on the webinar here, to think about what your total sales are and divide that number by 1.5 million to 2 million bucks and say that's probably how many sales and admin people I have. And remember who I said was in that category: dispatch, sales, back-end office, and warehouse. So how many do I have? That would tell you how many you would need if you take your sales divided by 1.5 million to 2 million. And then you'd ask yourself, do I have too many? Now, if you only have $1 million in sales and you're dividing it by 1.5 million, the chances are you can't get by with less than one person, right? And this is that break-even thing. You have to get yourselves up to a specific level before you have enough to really make it, to really make hay on the base number of people you need to run an office, right? And as you get bigger, you start to reap the benefits and yield the benefits of economies of scale. So I think $2 million is a pretty sound benchmark until you get to around 10 million or so. After that, you probably would expect your sales per employee to be a bit higher than 2 million. I can't tell how much higher because we didn't have enough participation to dissect the turnover categories further than we did. But I will say that when I studied this in the US, their sales per employee increases as sales increase. And I studied this in a bunch of different industries, and it typically runs this way. But this is where you outperform the US companies. They use way more sales and administrative people to drive their business than you do. Theirs is considerably less than 1.5 million. Okay, now maybe that's because they have those high margins, so they got to get out there and spend it. Or maybe the reason they have high margins is because they're investing in salespeople that sell based on service, not based on price. They are not order takers, they're selling, and they're trying to sell to the people who want the most reliable person to show up on the schedule, that the job goes well, that job doesn't have accidents, it doesn't have hiccups during the job, and they're reliable performers, and they're not willing to cut their price because we only have so many people and we want to do the best business we can. Now, we're describing an environment then there where there's a certain amount of supply versus demand here, where you're under high demand, you can do that. And when the market is soft, it's harder to do that. And I think we're feeling a little bit of the pressure on that. But this is just one of the other things that you can, bits of information in the study you can use beyond profitability to help you identify, am I getting my mix? I'm getting the whole thing right. One of the other things that's really important to consider is the cash flow metrics, you know, beyond just profitability. How are we doing with cash?
Yeah, that's right. I mean, we talked about the productivity. We've talked through some of the profit numbers, but I think it's appropriate we have a look at cash. And earlier we said profit and cash are not the same thing, and that debtor collections is a big driver of cash flow. What did the numbers say about how quickly this group and the industry is collecting, Barb?
Well, it's pretty interesting. There's a pretty big discrepancy here. I will tell you that some people had average collection of debtors from debtors of as low as 28 or 30 days. But these are medians. Half of the companies had a number higher than 68 days, half collected quicker than 68 days. When we look just at those profitable people, they're worse. Half of them collected in longer than 105 days, half of them collect quicker than 125 days. So you can see that also when you look at the under 2 million and over 2 million, the bigger they are, the worse they do at collections. And we think, hey, wait a minute, these people who make money and who are big, they must do everything right, correct? Wrong. So I have to think about what influences this. And, you know, maybe it's a reflection of who they're doing work for. Is it possible that those people with the higher profit percentages that are potentially bigger, because remember they're at 5.7 million per year on average. So maybe they're doing government contracts or institutions, a high amount of commercial work. It can certainly take a lot longer to collect on a large commercial contract than a small residential contract, right? So I think that has something to do with it. But another thing that I know influences this is how much you're paying attention to it. Are you really working the problem? Are you somebody that really gets out there and works to make sure it gets collected? And it's possible that if you're flush with cash and you're doing well, you're not paying as much attention. Or it could just be that you just figure, hey, she'll be right, mate. She'll pay me on time. It'll be all good. All I got to do is go and do the next job. Whatever it is that's causing it to be slow, I can tell you that a day matters. This is a place where we can fix things. There are lots of things we can do to collect quicker. And if you ignore it, it gets bad quickly. But one day really matters a lot.
Yeah, it does, Barb. One day makes a huge difference, and I work with people to focus on their debtors right across different industries all the time. And people are quite shocked at how much difference one day can make. And the higher the turnover, the bigger the issue. So if we just walk through an example, let's look at $1 million worth of turnover. We just divide it by the number of days in the year, 365, and we can see on average 1 day's sales or improvement in collection is $2,700 per $1 million. So if I collect 1 day faster, that's $2,739 I'd have in the bank. Or if I'm running an overdraft, I can reduce my overdraft by that amount of money. You know, if I'm a $2 million company, obviously that goes up to about 5,500. And if I'm in the median company of the study, which is 5 million, that's 13,000 per day or 27,000 per day if I'm at $1 million. But keep in mind, that is 1 day. All of those examples are just 1 day. So if the median company from the study collected 10 days sooner, they'd have 137,000 more cash in the bank, or have the ability to reduce their overdraft by that amount of money. I think that pointing out these types of things can really help a company improve their financial performance. I think it's a great question for our audience too, Craig. So let's put up the third and final polling station as we head towards the end, which is, how are you going with debtor collections on average? What is the collection period? And you've got 5 choices. You focus diligently and you're collecting ASAP. You focus diligently, but you're a bit slow. You could do better if you put more energy into it, or hopefully not, but we're dreadful. We've got to make it a priority, or we're dreadful. Oh, that's just a repeat question.
Sorry.
That's all right. So one of those top 4. And let us know, Craig, when the results start to come in.
They're pretty quick, these guys.
Very interested to see.
I think we're there.
Let's have a look. This will be interesting. It's pretty well spread. I'm pleased to report, Barb, that no one's in the dreadful category. If we go from the top, the diligent and collecting ASAP is 45%. We focus diligently, but are a little bit slow, 36%. We could collect quicker if we put more energy into it, 18%. So pretty good spread.
I'm glad to see that we're working the problem, because it really, really does matter. So as promised, I want to kind of wrap by talking about what can you do with this information, because participating in the study doesn't really improve your performance. Looking at numbers all day long just makes your head spin. It doesn't really change your results. But if you did participate, you got your interactive workbook containing your numbers compared to the benchmarks, along with a template for using the information to build a business improvement plan. And these are the steps in that plan. Okay, first, you assess your results. What are you doing well or not so well compared to the benchmarks? Now, before I get too far afield here, if you did not participate in the study, this process works equally well for you. You need to start by assessing what you're doing well or not so well from the numbers you have. You can either compare your information to your own past results to see how you're trending, or if you are a member, you can ask for a copy of the study and see how your results compare to those in the reports. So once you've got your list of this is what I do well and this is what I do not so well financially, the next step is to say, what's the most important thing to fix? Now, based on our conversation, what do we think are the most important things to fix? Equipment utilization issues, driving sales, getting that balance between the cost of our infrastructure and the volume that we can produce. That's what we have to prioritize. Now, how do we do that? We brainstorm with the people on our team, with the other members in our association, and the people that we respect, and say, how do we make this work? How do we get this right? We think out of the box. We figure out what we need to do differently. We don't keep doing the same thing. We find out what we need to do differently. And talk to your peers about this. Talk to your accountant, your banker or other people that you trust about how you can improve your business. Get a think tank on your team so that make a team think tank so that you can get good ideas, because brainstorming does work best with a variety of brains. It's hard to do by yourself. Once you've identified what do you have to get right, set some goals, things that you can measure and say, here's my target of what I need to do. I need to get this many jobs at this average job. I need to have my equipment at 67% utilization, like 67% of the hours that it could be working, it is working. I wish I had that benchmark for you from what the numbers are, but as I mentioned, we couldn't get the time information. We asked for it, but most people couldn't provide it. And so those are the types of things that you could measure to get yourself on track. So now all of that stuff is great, but nothing happens until you engage, till you write yourself a plan and you get it in gear and you get it done. So this is this process, and or it's actually a process for you. It's a process for me. So once you work through this, you find your way forward. So that's why we measure. That's why we do this benchmark study, is to find ways to improve our business. And this is the template that allows you to do that. So this is the point in the program when you can stump the experts with your clever questions. So if you have a question for either Stuart or me, please feel free to type it into the chat box and we'll do our best to answer. I would like to make this offer, though, to any members who, or somebody who is contemplating membership and decides they will join, that if you would like a report comparing your numbers to the numbers in the benchmarks, if you will complete the survey form, I'll do that for you for free, just in the spirit of let's get more people involved and let's get this benefit to more people, because the reason we do it is to make people more successful. So I've put that email address there that says cpaa@profitsoup.com. If you want a report and you didn't send me your numbers, shame on you, you should have, but you don't have to live in shame forever. You can still do it. If you send me an email that says, Barb, I'm sorry, if you'll forgive me, if you just send me a survey form, I'll fill it out and you can give me a report. I'd appreciate that, and I will do that for you without any cost, because we've set up this process. A big part of what's involved in doing this is us creating the survey, the infrastructure, the database, the reports. I mean, we built something special for you, and I want more people to be able to use it. So anybody who would like that, to take up of that offer, just send me an email at cpaa@profitsoup.com. And if you have any additional questions that you didn't think of while we were here today, go ahead and send them off. And we're happy to chat about this stuff. I'm a little bit off on time zones. I'm in the US in the West Coast, so it's 5 p.m. for me right now. But Stuart's in a bit north of Sydney in the Northern Beaches area. He's happy to have a chat with you if you can get him off of the waves.
So we've got a question here, Barbara. I might just read it out. It's a fairly long one.
Yeah.
I wasn't involved in the benchmarking process, so I'm unclear on how the data was collected. Can you tell us a little about how was the integrity of the benchmarking data assessed? some data is very different than I expected. So I think this is an observation about how the data was collected, how you tested the integrity of the data, and their observation is some of the results don't marry up with their experience.
Yeah, great question. The way we did it was we created a survey form that has balance sheet and income statement information on it, and it has very clear descriptions of what goes on each line, so that even if your balance sheet and your P&L didn't line up exactly with the categories, the information was there for you to say, oh, I'm supposed to put all my tire replacements and my fuel and things. I'm supposed to put all my fuel on this line and my tire replacements and my repairs on this line. So the instructions were there. And we can guarantee that if we wrote instructions, everybody read them and everybody followed them exactly, right? Well, maybe not. But we do our best. And so we know that sometimes people don't follow the instructions too well. And so we actually have data integrity routines where we can look at something, and if this number is too far afield of that number, there's something must be wrong, and we'll reach out and ask people a question. And if you participate in the study, you may be one of the many who received questions from me that said, something doesn't look quite right here. Is it possible that you didn't split this out? And that did happen. I think one of the reasons why the results are not what you in some areas are not how you expected is because there was just a giant spread in the size of the companies that were there, and we didn't have this great mass that we could slice it down into companies that were very, very similar in size. And there was actually in looking at each individual response, there was a big discrepancy in results. Some were doing really well and some were doing really poorly with the same amount of business. So I can understand why you feel that, wow, that isn't what I was expecting if you're on one end or the other of that spectrum. When the other thing that we do, if it just looks too odd and it would just taint the numbers, and I know something is just not right, we'll actually throw them out. And we actually did throw a couple of surveys out because I could tell that even if the numbers were correct, they were such outliers compared to the group, they would have made a giant swing in things. So that gives you a little bit of insights into our process. We have some data integrity procedures that we run, and we compare numbers to look for obvious questions. A lot of what we look for is because of what we learned by doing projects like this in the US, which we've done like 4 studies for the American concrete pumpers. And so we've learned a bit of a process of what to look for. And then we do benchmark studies for other organizations too.
Thank you, Barbara. I actually try to paraphrase some of the statements that you made and send it in a response to everyone so that they've got a record of sort of key issues. But I think the summary for me, Barb, was that you guys managed it with great integrity. The challenge is really getting more people to participate. The more distribution or different types of entities involved in the survey will improve the data integrity, improve the distribution of results, and give us a more accurate snapshot of how the industries are performing across a broad spectrum.
Yes, and there's a critical mass that you get a certain number, and like if you had 100 of them and you got another 20, it wouldn't change the result much. But when you have a small group, which is what we do, we're working with a small group of responses, it does make a big difference when there's a swing. Mm-hmm. So, we love the work that we do. We love working with you guys, and anything that you want that you said, gee, I wish you would have been able to do this, or you had done that, I love to hear it, because I love to take projects to the next level. So we're always open to your feedback for how we can improve.
Okay. Barbara, there's no sort of follow-up questions at this stage, and I think we're now 10 minutes past our allotted time, so I'm mindful people need to get on with their days. Look, thank you for that for that wonderful presentation today. Thank you for your involvement in the project since late last year, and the work that Stuart did coming to the Expo and getting people excited and enticed. It's a new journey for us. It's something that I think will give us better understanding about the industry. Being a management person, I have one credo: if you can't measure it, you can't manage it. And I think if we can improve our understanding of some of those key statistics or KPIs, we can more effectively manage our industry and improve our profitability and performance. Where to from here? As I said, this has been recorded. We'll post it online. Within the next day, we will be sending out to all members a copy of Barbara's completed report so that you can even individually review those results against your own financials, or as Barbara has graciously offered, if you reach out to her with the email address she provided earlier on, they will do a freebie for you. How good is that? And hopefully you'll get engaged in our next benchmarking exercise. So on that note, thank you so much for your participation. Thank you to you, Barbara. Thank you to you, Stuart. Wonderful. Pleasure. And look forward to everyone having a safe day. And as Andrew Mitchell used to say, keep pumping. Thank you so much, and goodbye.
Thanks, everyone. Bye-bye.